Do you need mega cap tech to stop going down, to stabilize, or do you say it doesn't matter as much because there's something else to pick up the slack? How do you view that? Because it's undeniably one of the reasons why we're even having this conversation, why the S&P is down 5.5% this month,
and the Nasdaq's down 6-7%. Tesla's down 22%. I mean, that's a big move in 1 month, right?
Well, Apple's down 11.5, right? And these stocks matter a lot. They matter on the way up.
Yeah.
They sure as heck matter on the way down.
Yep. Well, we have, the last 13 Fs, we had Dan Loeb pile into AI-related stocks. David Tepper went all in as well. So I think that's a longer-term story that's going to play out, not just till the end of the year. That's going to play out over the next 5 years, 10 years. And that's a major story that I don't think is getting a lot of credit. But those stocks obviously were kind of everybody piled in at once. They've come off. And I think that towards the end of the year, we're going to end higher than we are right now. And I think even at the end of the month of August, we should end higher than where we are right now.
History shows that things can get ugly and volatile for the U.S. stock market in August and September. So a rocky start to the month shouldn't be a big surprise. Indeed, even bulls might pine for some near-term consolidation after a torrid run that saw the S&P 500 index SPX rally nearly 20% over the first 7 months of 2023. Through August 18, 2023 close, the index is still up nearly 25% from its bear market closing low of 3,577.03 hit on October 12, 2022. Thomas A., founder of Sevens Report Research, contends the rally has been built on 3 pillars. Firstly, the Fed is now seen by many investors as likely finished or nearly finished raising interest rates. Secondly, the economy appears set to possibly avert a recession altogether. Finally, inflation has remained largely on a downward path.
Let's bring in Nancy Tengler, CEO and CIO of Laffer Tengler Investments. All right, Nancy, jump on in. You probably caught a little bit of that previous discussion. So, I know it's not like you're going to be out of the market, but what are you doing here?
Well, Kelly, I think one clarification. I think there's a possibility that inflation will tick up, but we have been in the camp, and there are others there that have said previous inflationary periods, and there were 7 in modern history, what we've seen is that inflation is symmetrical on the way up and on the way down, but it's not necessarily linear. And that's what I think may happen, is that we'll get a surprise and the market will be caught flat-footed. That's an opportunity, we think, to go back in and buy some of the tech names that we were buying last fall, have been trimming in the second quarter, and may want to own more of as the secular narrative and tailwind of digitization continues, and we want to have more. We may want to get more exposure.
Sure. So what's on the list? Are you expecting for sure more market weakness in kind of the months or quarter or two to come?
I think it's a fair. I think it's a fair bet. We ran pretty hard, pretty fast, not just from October, but certainly year to date. I don't think stocks are frothy, but on average, every 12 months we get a correction. Historically, we haven't yet really seen that. We sort of tried in July, first week. I think it would be healthy for the market if we got a pullback. Let people take a breath. The volume this time of year is pretty spotty. So I think that might just be a continued catalyst. And we're seeing the futures up strong almost every morning and then a sell-off into the end. So that usually tells us that we're going to see some sort of a correction. But we think we're in a bull market. So I don't think you want to run away. This isn't. I don't think this is 2022. It's just an opportunity to reposition, and that's actually what we will do.
Major indices dropping for a third straight day. Let's bring in Catherine Keating, CEO of BNY Mellon Wealth Management. Catherine, great to have you with us.
Good morning, Melissa. Good morning, Joe.
Morning.
Great to be here.
It seems like rates most recently has been the reason why stocks have been having some difficulty maintaining their gains and moving higher. How do you view, a 4.3% on the 10-year, for instance, and if we stay at that level for longer?
Yeah, so if you think about the market this year, we started the year, bond market, stock market, all ready for recession. And then what happened as data came in, it was a little stronger than expected. By May, all of a sudden the market said, maybe we're not going to have a recession. And you saw the equity market just leap forward in May and June and July. Now, here we are in August, and what's the market saying? Oh my gosh, we may not have a recession, and you're actually seeing that in the bond market, obviously, with stock market sold off 4 or 5%, bond market sold off even more with the 10-year up 60 basis points to 430. So what does that mean? You know, our base case is inflation is sticky. It sticks around a bit longer. We've had a great drop from 9% to 3.2, but the 3.2 down to the 2 is a little less straightforward. Interest rates do stay high for longer. But our base case is that because of the strength of the economy, we can have a slowdown, we can have a correction in the market, and we can have a slowdown in the economy without going into recession, and that remains our base case.
Is that the way you're positioning your portfolios for a pullback in the markets?
It is how we're positioned. So I would call our positioning in our portfolios balanced. In other words, we're at our normal equity weight. We're not overweight. We're at our normal equity weight. We're overweight the U.S. for a variety of reasons. And we're also balanced when it comes to the bond market. You know, we understand that it's been a long time since the 10-year was at 4.3%, 15 years. I greeted all of our new analysts, our college graduates that joined our company on Monday, 1,000 of them. And, you know, when you think about the last time the 10-year was at 4.3%, they were 7 years old. It's been a long time. But nonetheless, you know, our base case is it's good to be balanced in bonds, too. And now's actually the time to take some duration. We haven't done that in a long time because rates have been so low. But we think now's the time to take some duration because then bonds behave like bonds. You get your yield, which is a bit higher, and you also get a gain when the market goes down.
So trouble for the market would emerge and would essentially undermine the 3 pillars of the rally if economic data were to falter and begin pointing to a hard landing, or core inflation leveled off or bounced, or Fed Chair Jerome Powell signaled another rate hike is definitely coming and caused a further rise in Treasury yields. As such, investors should expect a substantial decline in stocks. A decline of much more than 10% would be likely in this scenario, as it would undermine most of the rationale for the gains in stocks since June and perhaps all of 2023. Stocks have rallied since late last year as fears priced into the market didn't materialize, but now that dynamic is gone. Thanks for watching. Like, share, and subscribe.